Picture this. It's Halloween, 2008. No massive press conferences, no big corporate fanfare, none of that. Just a quiet 9-page document dropped onto a super obscure cryptography mailing list by someone or some group we don't even know. Literally just a silent blueprint without anyone noticing at first, completely rewired the entire global financial system.
Which brings us to the biggest question, right? Who in the world is Satoshi Nakamoto? It's been almost 2 decades, and this mystery still absolutely blows my mind. This creator, or maybe it was a whole team of people, we literally have no idea, used this fake name to pitch an idea that went straight for the jugular of modern banking. They literally just tossed this mind-bending math puzzle onto the internet and then ghosted, just vanished, leaving all of us to figure out what the heck to do with it.
In the spark that started this wildfire, that original 2008 white paper, Nakamoto wasn't just throwing out an idea for some, internet money. They were pitching a complete peer-to-peer electronic cash system. The whole game plan was to build a network running strictly on cryptographic proof. No more relying on traditional institutional trust. Basically, you didn't need to put blind faith in a bank anymore. You just needed to trust the math.
But okay, it didn't stay a theory for long. Look at this number, 10,000. That is the exact moment the tectonic plates shifted. We're talking about 2010. The first actual real-world transaction, what everyone now calls Pizza Day. A programmer handed over exactly 10,000 Bitcoin for 2 Papa John's pizzas. I mean, just let that sink in for a second. That is the exact moment this wild, abstract math experiment officially became real, spendable money.
So why did Satoshi even bother? Well, they spelled it right out for us in the text, saying what is needed is an electronic payment system based on cryptographic proof instead of trust. See, everyday commerce is totally dependent on financial institutions to play the referee, right? And because banks have to mediate disputes, payments can be reversed. And mediation? It costs money. That friction kills small, casual transactions and forces sellers to demand way too much of your personal info. Satoshi just wanted to build a world where 2 people could just transact directly. No middleman required. Period.
Now you might be wondering, if there's no bank, what stops someone from just spending the exact same digital coin twice? Satoshi's fix for this is called proof of work. Okay, think of the blockchain like a giant neighborhood bulletin board. If you want to pin up a new page of transactions, you can't just staple it up there. No, you have to solve this incredibly difficult math puzzle first. You actually have to burn computer processing power and electricity to prove you did the work. Once your page is pinned, it gets permanently locked to the previous page. So if a hacker wanted to change a past transaction, they'd have to completely redo the work for that page and literally every single page that came after it. It's basically impossible.
So let's break down the actual nuts and bolts of how this runs. It's really just 4 main steps. First, new transactions get shouted out, or broadcast, to all the computers, the nodes on the network. Second, every node sweeps these up into a block. Third, it's off to the races. The nodes compete to solve that super tough computational puzzle. And finally, when a node cracks it, they show everyone the block. If all the transactions check out, the network chains it up, and everyone immediately starts working on the next one. It's essentially this massive, decentralized CPU voting system that completely fires the central bank.
But hold on, as this chain gets longer and longer, wouldn't it just eat up every gigabyte of space on your computer? Satoshi was already 2 steps ahead with something called a Merkle tree. I honestly love this concept. It's like a magical digital filing cabinet. It elegantly compresses all that transaction data by pairing things up and squishing them together over and over until there's just one single root hash left at the top. Because of this, you and I can securely verify our payments without having to download the entire gigantic history of the global network. A real game changer. Okay, let's talk about privacy, because this is a total paradigm shift. With your normal bank, your identity and everything you buy is stuffed into a private vault, and you just have to trust that the bank keeps it safe. Bitcoin flips that entirely upside down. The ledger is totally public. Anyone can see it. It's literally like a giant stock ticker in Times Square showing every single trade. But here's the kicker. The names attached to those trades are just random gibberish, your public keys. So the transaction is out there for everyone to see, but who you are? Totally anonymous. You can actually see it perfectly mapped out right here. The architecture is completely inverted. In the old world, the trusted bank was the firewall standing between the public and your transactions. But in Satoshi's new world, the firewall is moved. It sits directly between the public transactions and your actual identity. Now, to get people to actually run these computers and do all this heavy lifting, the system pays them in newly minted coins.
Satoshi even wrote that adding new coins into circulation is analogous to gold miners expending resources. But instead of giant bulldozers digging up dirt, it's computer chips eating up electricity to solve math. And I think that gold mining analogy is just spot on. It bridges the gap between the dry technical code and how this thing eventually turned into a wild, heavily traded financial asset.
And oh boy, did it get wild in the real world. Just look at this timeline. From that quiet white paper in '08 and the famous pizza in 2010, this thing skyrocketed from a nerdy internet forum project into a global obsession. But it wasn't a smooth ride. There were some brutal growing pains, like the absolute disaster of Mt. Gox in 2014, before Wall Street finally started taking it seriously around 2018. And now, heading into 2025, we're looking at a deeply matured market.
Actually, let's just pause on 2014 for a second because the Mt. Gox collapse was a massive wake-up call for everyone. At its peak, Mt. Gox was handling something crazy, like 70% of all Bitcoin trades on the planet. So when it got hacked and went completely bankrupt, it was devastating. But here's the really important takeaway. The actual Bitcoin code wasn't hacked, not at all. What got hacked was the centralized company holding everyone's keys. It was a very harsh, very painful reminder of exactly why Satoshi warned us against trusting centralized middlemen in the first place.
But even after taking a massive hit like MGOX, the network just kept chugging along, proving it actually worked. By 2015, you had over 100,000 merchants worldwide saying, yeah, we'll take Bitcoin. We're talking massive companies, Microsoft, Dell, Newegg. They were all jumping on board as early as 2014. This was a super critical turning point. It proved Bitcoin wasn't just some passing internet fad or a speculative bubble. It was actually starting its long march right into the mainstream economy.
And by the time we look at the data from 2018 through 2025, you can see a massive shift. Bitcoin wasn't this isolated rebel internet money anymore. When financial analysts look at dynamic correlation, which is just a fancy way of saying how closely Bitcoin's price mimics traditional stock markets, they found it was actually moving in tandem with major indexes like the S&P 500. Wall Street wasn't laughing anymore. They were actively tracking it, seeing if it could be a legit way to diversify a traditional stock portfolio.
Of course, as crypto got bigger and bigger, people really started scrutinizing how it was built, especially the massive amount of electricity required for Bitcoin's proof of work. And that scrutiny, it drove incredible innovation, leading to alternative models, mainly proof of stake. So instead of Bitcoin's model where miners burn crazy amounts of electricity running hardware, proof of stake networks have users lock up their own crypto as collateral, their stake, to validate transactions. It completely swaps out an energy-hungry hardware race for a purely economic incentive model. And that single pivot just ignited an explosion across the tech world. The blockchain space rapidly mutated way beyond Satoshi's original 2008 blueprint. This underlying tech evolved to support things like complex smart contracts, which are basically digital agreements that execute themselves, and that birthed the entire multi-trillion-dollar decentralized finance ecosystem we see today. It is literally a whole new financial universe.
So that leaves us at a really fascinating crossroads right now. We've traced how a quiet, 9-page PDF turned into a monstrous asset class that forced its way straight onto Wall Street. But think back to the very first line of that white paper, a peer-to-peer electronic cash system. So here's the million-dollar question. Is Bitcoin's ultimate destiny just to be a kind of digital gold sitting in the vaults of institutional investors? Or will Satoshi's original vision, a world running on everyday, trustless peer-to-peer cash, finally become a reality? It has been a wild ride since that first email went out. And honestly, I think the next chapter is going to be even more incredible to watch.